On this show, we almost always talk about the stock market. Why? Because stocks have a tremendous track record of building wealth. The reality is, though, there are a lot of other asset classes we can use depending on whether we want to build or preserve wealth, and also different ways to do both of those things. So, today we're going to talk about one of those asset classes. Welcome to Stock Stories. All right. Welcome to Stock Stories, the show where we decode the business behind the stock. Hi, I'm Alex Mason, your stock storyteller. My wife and I went from not knowing anything about investing to becoming financially independent by 30 years old. And my goal is to empower you with the knowledge and skills that you need to successfully invest. Now, this is a show that explores the fundamentals of how businesses work and teaches you to become a better thinker. And I'm studying every company in the S&P 500 and more. And today we have a little bit of a different episode for you today. Instead of studying a specific company, I actually have a great interview with someone who I think will help you become a better thinker. And we're going to talk about a specific asset class that I think is really interesting. So let's go ahead and get into today's episode with David McAlvany. David, thank you so much for coming onto the Stock Stories podcast. Welcome.
Alex, great to be with you. Look forward to our conversation today.
Thank you. Yes, and let me just introduce you here. Right now I'm here with David McAlvany, the CEO of McAlvany ICA, International Collectors Associates. You're an investment advisor. You're focused mainly on precious metals, and you're also CEO of a company called Vaulted, which we'll get to later on in the conversation. And also, you're an author. Is that correct? You wrote a book not too long ago.
Yeah, might not be much of our conversation today, but the title is The Intentional Legacy. For many of us who are interested in the financial markets, sometimes we will focus on the balance sheet aspects of growth and diversification and growing wealth through time. And what I did, Alex, was take a look at the other things that need management in our life, the intangibles that sometimes get neglected. They don't make it onto a normal balance sheet, but the things that go into being a husband, being a father, and the relationships that you may have with siblings, the stuff that frankly gets really messy if not cared for. So the kind of attention that you give to value investing and stocks and how to look at filling out a portfolio adequately. I would say that same kind of bottom up work needs to be done as you look at yourself and as you develop a life trajectory. So the intentional legacy is really about the aggregation of choices and how all of those choices end up setting you on a certain path. So when you are in the financial world, you might say, well, what is it going to take for me to go from zero to $1 million in assets? Well, this is the same kind of question. What is it going to take for me to go from here to a certain kind of husband or a certain kind of father? So it's just reverse engineering. You might appreciate that from your background in aerospace, but it's reverse engineering what you want to know what the simplest decisions are that you need to be taking today. So it ends up being very practical. But enough about the book. It's missing, frankly, in the literature, just because there's so much that you can do from the standpoint of estate planning and having a great tax attorney to maximize wealth intergenerationally. But there's something else that we tend to pass on as we think about legacy, and it is those intangibles, if you will. So I was going back to 2015 and 16 when I was writing that. That's not the day job. The day job is as a portfolio manager in equities and also our precious metals business, which now celebrates its 50th year. So we keep pretty busy.
Oh, that's excellent. So yes, maybe we can talk about the intentional legacy some other time. But congratulations on 50 years with your firm. And I guess I just want to begin the conversation a little bit discussing some fundamentals of the asset class or asset classes really that you have experience with. because a lot of the people who historically have listened to this show we're focused on stocks. We're focused on equities. We understand that if we buy a piece of a company with a share of stock, that it's going to grow over time based on the productivity of that business and how the market is valuing that business. And that's going to create wealth for us. Now, what you have experience with is, of course, something that is something completely different. So maybe we could talk a little bit about just introducing the concept of investing in precious metals. Why should the individual investor be concerned at all with investing in something like gold or silver?
Yeah, I think gold is the perfect complement to an equity portfolio. And I say that because that's what the numbers bear out. If your emphasis is on growth within an equity portfolio, you know that there's certain periods of time where you have significant drawdowns. And, maybe we're heading into a bear market now. That remains to be seen. But certainly we had significant volatility in March of 2000. We also had significant volatility in 2008. More volatility in March of 2020. I mean, you can look at periods of time where you can see 20, 30, even 60 or 70% declines, depending on the subsector you're talking about. In those periods of decline, the behavior of gold is what really complements an equity portfolio so well. It's not anti-stock. It just happens to be an asset that has safe haven characteristics. So it's moving higher when stocks are moving lower. And I mean, we saw this in really interesting fashion this last Friday, where equities are selling off pretty hard. And we had one of the largest inflows into gold, about 27 tons purchased through GLD, which is an ETF product that allows you to have access, a proxy to gold. We'll talk about the pros and cons of that later, perhaps. But the demand increases for gold as a safe haven, and the performance increases as stocks are sort of hitting the skid, so to say. So if you wanted to look at the math, we did this back in the 60s and 70s, and more recently, about 2018, looking at kind of what the perfect mix would be if growth is your objective in an equity portfolio, the perfect mix between stocks and gold. And it's pretty close to 75% stocks, 25% gold. And the reason for that is a couple of caveats there. One, you rebalance annually. And what that annual rebalance forces you to do is essentially lower your cost basis on the position which has been hit, and you're coming out of the premium asset. So in the case of an equity market drawdown, your equity portfolio has declined, your gold portfolio has increased, you're selling your gold, you're buying more stocks at the low, and you've got the advantage of not only having an appreciated asset in the down market, but you have added purchasing power. It's not just a cash position to lower volatility in the portfolio, but it's actually appreciated, and you get to take some of those gains, come into a losing position and lower cost basis. So to me, gold is the perfect complement for an equity portfolio. Lowers your total volatility. And again, those, as we looked at those figures, 75-25 over a 20, 50, 100-year period, you end up having a stronger performance with an annual rebalance than just being 100% equities. Pick your favorite index, S&P 500, what have you. You're going to outperform the equity markets because you've got something very positive to do in a down market, while everyone else is sitting there playing the patience game, hoping to get back to break even.
Okay, very interesting. Yeah, thank you for sharing that. And I think it's interesting because, well, first of all, so many investors they don't stay in investments when markets are down. We know from many studies that investors simply just jump out, and they jump in and they jump out. Behaviorally, there's a huge gap there between theoretical performance and actual performance. But then kind of setting that aside and going to your point of allocation, you're talking about a 75-25 split between equities and gold. What's often touted conventionally is to have some sort of a mix between stocks and bonds, right? There's a lot of target date funds out there that people have access to in their 401k or 403b plans that naturally shift from a mostly stock mix to a mostly bond mix over time. And the touted benefits of that are similar to what you're saying, right? That you're smoothing out volatility over time, and that would be better than a cash position instead of cash or using bonds, because bonds are an interest. Bonds can provide some return. And so what I hear you saying is that gold offers similar or better benefits than bonds with that kind of a structure. Can you maybe explain why someone might consider gold as opposed to bonds in that kind of a scenario?
Absolutely, because I think one of the things that we assume, and this is sort of, we're all products of our environment and education. Modern portfolio theory it perfectly suits the target date fund. Where you have a certain age, a certain destination with retirement or some objective, and so that blend of stocks and bonds is the way that we've been educated. And in the case of liquidation, there is clearly a benefit to being on the credit side as opposed to the equity side. So in that sense, bonds are safer than stocks. But I think people extrapolate from that one point and say, well, then we should treat bonds as safe havens. And of course, there's a whole mix of bonds which aren't necessarily safe havens. If you're looking at investment grade debt, if you're looking at high grade or high yield, what used to be called junk bonds, you've got all different kinds of credit quality, which is one differentiation in the bond market. You've got the other differentiation in terms of the maturity schedule. How much time is your money invested in this bond, which makes it far more interest rate sensitive. So there's a variety of risks that impact a bond portfolio or a bond position, and I don't think you can treat it just as the safe haven to stocks. There's a little bit more complexity there. What you could say is that short-term U.S. Treasuries do have safe haven qualities similar to gold, and so you'll see the 10-year Treasury, that yield will come in and prices will go up, just like gold went up on Friday. You'll see those same kinds of behaviors with really safe debt. Now, I mean, the problem is today, and this is, I think, where gold has an advantage. Bonds are somewhat toxic in an inflationary environment because you're talking about a real rate of return ultimately. And so, if you've got a 1.75% yield on the 10-year Treasury, and we're currently running a 7% inflation rate, you're better than 5% negative in real terms. Adjust for inflation. And it doesn't matter that you're getting almost 2, you're still underwater by 5, if that makes sense. Again, and that's where we come to gold, where it's got 5,000 years of being of some use. And for most of that history, it was just money. It was money. I mean, if you go back to the stories of Hetty Green trading her equity portfolio, making millions of dollars, this is, over 100 years ago, very famous equity trader, this gal. I think they used to call her the Witch of Wall Street. There's a lot of people that didn't like her. Maybe they were envious at the time. She was perhaps very independent for a woman, and that wasn't fully appreciated 100 years ago. So be that as it may, anytime she came out of stocks, she went into cash. It sounds pretty normal, right? If you take gains. But at the time, cash was $20 gold pieces, because we were on a gold standard. Most of the world was on a gold standard, and that added a certain amount of trade stability. There were some very significant advantages in terms of market stability, volatility, et cetera, when it came to, talking about economic volatility, when it came to being on the gold standard. So today we think of gold as a commodity only, but to respect the role that it's played for 5,000 years is to see that actually it's just a reliable store of cash. Which is why we launched the Vaulted program, because we wanted something to be as close to cash as possible, just denominated in ounces. And so, you can go on your smartphone, go to the App Store, look at Vaulted, or go to your computer, vaulted.com, and it's a really easy way of buying gold. But really what it is a substitute for a bank account, a savings account. Instead of looking at the current inflation rate and saying, thank you, Jerome Powell, for the minus 7% this year, or the whole FOMC committee, you can look and say, look, I've got cash, but it's in ounces instead of greenbacks. And that's not a, I wouldn't say you do that with all of your cash, but it's a healthy complement. And it also recognizes the role that gold has played most fundamentally as an opt-out from risk assets. I think it still has a role to play in a portfolio. Vault is a great tool to be able to access it inexpensively with high degrees of liquidity without the hassle factor of saying, you've got 10 ounces of gold, in your home safe, and you need to take it to the post office and mail it, and it takes 2 weeks to get something. Like, there's all the complications. There's a lot of cons. There is a lot of cons to owning physical gold. This kind of cuts through that and says, okay, as easy it is for you to buy stocks on Robinhood, you can own gold, and your settlement process, if you want to liquidate it, is even better than stocks. You've got trade day +3 for stocks. You've got trade day +2 for vaulted. I mean, it's just, we wanted a great product, highly liquid, very reasonably priced, bringing gold back into its old role, a reliable store of value for your savings.
You touched on a lot of points there, and what I want to hone in on a little bit more is, kind of the aspects of owning gold and how it has been owned traditionally versus now. As far as owning it today, what are the choices that investors have? You mentioned ETFs earlier. I think that's really the only two options that I was aware of before coming across Vaulted was gold ETFs and actually physically owning it and putting my hands on it personally. Are there any other options for investors to own gold, prior to Vaulted? And then, of course, can you explain a little bit more about how Vaulted works, mechanically? How do you actually own the gold? How do you have it stored? How do you retrieve it? Those kinds of things.
Yeah, so I mean, the classic way of owning gold is in physical form, where someone would take delivery of it. And again, going back to, when gold was money, a $20 gold piece and a $20 bill were interchangeable. You could have one, you could have the other. Now it takes a lot of $20 bills to buy one $20 gold piece. And really, that's a story of the devaluation of the dollar. Over 100 years, you've seen a 96% depreciation in the dollar vis-a-vis gold. But the physical form is what people used to have jingling around in their pockets. And, for 50 years, we've had clients who've wanted to take physical delivery of their metals, or they've wanted to utilize IRA assets. So you can have a physical metals IRA. And we were the first company back in 1986 to put physical metals in an IRA. We've been doing that a long time. So, again, there's rules about IRAs where you can't take delivery of the assets. It's held in trust until you're in retirement, and then you pay taxes on what's pulled out, unless it's a Roth or whatever. So you've got the option of physical delivery. If you want an asset allocation and just say, well, I want 1% of my portfolio, and you want it to ride along your equities, next to your equities, ETFs are a great and liquid form of sort of a proxy for the metal. Now, you cannot take delivery of, say, GLD unless you're doing it in $10 million tranches. So it's not sort of the everyman gold. It's more of an institutional asset. And so you may have the asset allocation in the portfolio, but it is not accessible to you. It's not accessible to you. And you might say, well, why do I want gold that's accessible? Why do I want gold that's allocated in my name and deliverable to me? What's very interesting, if you go back to the global financial crisis, or 2008 and 2009, under normal circumstances, people don't worry about who their counterparties are, who has the asset that they're trading, what platform their stocks or bonds or commodities or whatever are sitting on. And then all of a sudden, there's enough chaos in the markets, like we had in the global financial crisis, and people start saying, are my assets there? Have they been hypothecated? Have they been loaned out to someone else? How do I know that I have my asset and there's not 5 claims on one asset? That's the nature of derivatives, is to basically take one pie, turn it into 5 slices, and then collect commissions and fees on each of the slices as if they were their own pie. So now you've got all of these top-level claims on one, underlying asset, and that's where people start to say, I don't know that I want to take counterparty risk. How about I know that what's mine is mine and that's it? So you see a mad scramble for the underlying assets in a context of crisis. And gold is one of these magic assets in the sense that it doesn't have counterparty risk. Now, in the case of GLD, the ETF, you are saying, I am willing to take counterparty risk with my gold position. I don't have immediate access to it. I can't take delivery of it, but at least I've got the asset allocation for the metals. This is one of the reasons why we launched Vaulted, because we wanted to say, okay, well, let's remove the counterparties, make sure that you have direct access to the metal, have the benefits of 21st century purchasing and liquidations, and an economic structure where costs have been compressed. The advantage goes to the investor. But still, there's clarity in terms of no counterparty fuzz. It's yours. You can have it. If you don't want to take delivery of it, then it sits there at the Royal Canadian Mint in Ottawa in the form of kilo gold bars. And if you want to take delivery of it, you can either take delivery of an entire bar, which is 32 ounces, or you can do what we call a dynamic deallocation and convert from the bars into coins or smaller products and have it delivered to your door. So the vaulted mechanics are pretty straightforward. Opening an account takes 2 minutes. Funding the account, you then have the option of placing the trade once funds are on account. Or we have something that's kind of interesting too. If you're not a market timer, if you're somebody who's just focused on the sort of the disciplines of, here's what I make a month and I want to have 2% go into gold every month. Well, you can designate that, and it's what we call our vault plan, where automatically that amount gets invested in gold as soon as it hits the account. So using, the mechanics end up being either wires or ACHs, where the funds come in and it's an automatic purchase if you like the vault plan. If you're more of a market timer, then you want it to hit cash, and you watch and you say, okay, today's the day that I want to do it. So you've got the flexibility of placing a trade at your convenience or having it happen on sort of a disciplined automatic basis.
Essentially what I'm hearing is, okay, with gold ETFs, you have the asset allocation benefit, but the con is that you have essentially given up the ability to ever own gold directly, because if you're talking about a $10 million requirement, then that's basically an institutional bar. Whereas if you own gold through something like Vaulted, then you have an app, you can allocate, I think it's as little as $5 you can use to purchase fractional ownership shares of gold. Exactly. Is that correct?
Yep.
Okay, as little as $5. You can do automatic withdrawals. So you have a lot of these benefits of modern technology for an asset that traditionally has been very difficult to own for the individual retail investor. So I am definitely hearing that, and that makes a lot of sense. I want to go back really quickly to something you mentioned when you were talking about the gold ETFs. You mentioned this term hypothecation, and I think that's, for maybe many of the listeners out there, that may not be a term that they've heard before, but it essentially means a pledge on assets, right? Is it possible for this collateral or this hypothecation to happen for other types of assets? Like, say, an individual investor, they're just getting started, they have an app like Robinhood or Charles Schwab or whoever, and they buy an equity index fund. Regular account, no margin. Is it possible for those assets to be pledged out to others? Is there that counterparty risk with different types of asset classes, not just gold?
Right. So when you buy the ETF, within the ETF basket are shares of various companies, and those shares are owned by and held by the institution. Now the question is, do they have the opportunity to loan out those shares to a short seller? And the answer is yes. And that's a way of making additional income as the person, take BlackRock as an example. They've got $10 trillion in assets. So you get this $10 trillion pool of ETFs and mutual funds, and they're not just sitting on them. They also have the opportunity to loan them out and receive an income from loaned out stock. And that's the process of shorting a particular position, is you have to go out and borrow it. And in that sense, The institution is hypothecating the underlying asset that is inside some structure. Could be your personal account, it could be inside of an ETF or inside of a mutual fund, but having an asset that's loaned out, this happens all the time. And you just hope that, the exchange goes smoothly, there's no ripples in the market such that, the math gets confused. And we've got great trading platforms where that doesn't really happen. You get into trouble when there's not only hypothecation, but rehypothecation. What if it jumps jurisdictions, and it becomes unclear who owns what, because now you've got multiple stops along the way in terms of this was loaned to you, and then you loaned it to somebody else, and then it was loaned on to someone else. That happened with MF Global. If you remember, a Goldman Sachs guru is running MF Global, and he starts rehypothecating, commodities positions and other equity positions to other foreign financial companies overseas, and then all of a sudden, the asset is held over here by a U.S. investor, and the U.S. investor says, "I'm ready to sell it, or I'm ready to do something with it." He's like, "Well, I actually don't have it. I don't have it because it was loaned out and then loaned out and then loaned out." So it's kind of how far down the daisy chain are you? And it caused the collapse of MF Global. It's a great study if you want to look at this issue of hypothecation, rehypothecation, and recognize the structural risks within the stock market. And it's stuff that you and I don't think about every day because under normal circumstances, it doesn't matter. We're operating smoothly. It's the extraordinary circumstances that all of a sudden reveal weakness within the equities markets. Tomorrow afternoon, one of the products that we work with in our asset management company is actually a short product. So we do a lot of critical credit analysis. If your listeners are ever interested, it's what we call a tactical short. But we do a quarterly conference call, and this week, a Thursday, Mountain Time, is when we're going to be, and you can go back and listen to the past shows or whatever, or the past quarterly calls. We're going to be looking at market structure. And this is one of those aspects that if you don't appreciate the structure that the market is built on, you may not appreciate the frailties implicit to the market. And the loaning out or hypothecation, rehypothecation, that is a part of the risk aspect within the market structure today.
Okay. So just to make sure I understand fully, if I was to own a regular equity index fund in a regular brokerage account, no margin, there is a risk of hypothecation and rehypothecation of those assets.
Look at your agreement. Look at your account agreement, and I think you'll find in the fine print you've given the custodial firm the right to lend. Now that's a box that you can check that if you don't want them to lend out your stock. But that's again, fine print of any account, whether you're talking Schwab, TD Ameritrade. I don't have a Robinhood account, so I don't know. I haven't read that one, but I'm one of those guys that's weird enough to read the account agreements. And that's standard form.
Okay, thank you for clarifying that. Yeah, so I imagine it works just the same as if you go to a bank, you give them your deposits, they lend out your deposits. That's
exactly right.
Revenue, right?
Yep, that's exactly right.
All right. Okay, so there's this risk that I'm almost positive the vast majority of retail investors just do not even know about. And this takes place with not only equities, but also other types of investments, such as a gold ETF. And so what I hear you saying is that if you own some other kind of asset, such as gold, you eliminate that counterparty risk because you actually own it, and there's that direct ownership. So I understand that aspect of it. Is there any particular reason that you have a focus on gold as opposed to other types of metals, such as silver, other types of hard assets, let's say?
Sure.
Is there anything in particular that differentiates gold between those things?
Yeah, that's a very fair question. And by the way, you're a great listener. I appreciate your engagement in our conversation today. You do a great job. So in our asset management company, we are focused on hard assets in general. Precious metals are part of that, but infrastructure and real estate and global natural resources fill out sort of the pillars within a portfolio. So we are interested. Um, for the purpose of vaulted, what we wanted was the least volatile, the most reliable store of value. You can look at silver, you can look at the platinum group metals. They're also in the precious metals category. They just have a different volatility profile. And so for some investors, that is more desirable, more upside, and you don't care that there's more downside as well. Volatility is your friend. Volatility is not everyone's friend. And so I think it depends on the expectations that you bring to the equation. If you're looking at something like vaulted and you want it to be a reliable store of value, you're going to strip out as much of the volatility as possible. The benefits of silver, the benefits of platinum, over and above gold is that they have huge industrial uses. So not only are you looking at what you have in gold, which would be central bank demand, jewelry demand, investor demand, but now with the white metals, platinum, palladium, silver, you're talking about industrial demand being a huge component in that mix. What we do oftentimes with investors is look at the relationships between the metals. So on a relative value basis, which of those metals is more attractive? So for instance, today you're trading at about an 80-to-1 ratio. If you take the price of gold and divide by the price of silver, 1 ounce of gold equals roughly 80 ounces of silver. Classically, that number is closer to 40. You would argue that from a value perspective, silver is a better value than gold today. Yes, but in the case of, just so you don't, get the horses racing here, you can get enthusiastic about buying value, but also recognize the risk implicit. Cheap can always get cheaper. That ratio's gone to 125 in at least one instance. So you're at 80-to-1 today. You can still see downside vis-a-vis gold in silver. So we like them. They do have a place in a portfolio. If you don't like as much volatility, then you just shrink the exposure in a portfolio to the white metals.
For investors with a mandate or a focus toward wealth preservation, would you say that's primarily the types of clients that you serve, the types of investors that you serve with your management style?
Yeah, I think so. I mean, when you're talking about the asset management side of our business, it's asset preservation, it's conservative growth. And if you're talking about the metals side of our business, the precious metals business, which goes back to 1972, those are investors that are somewhere between, there's a whole spectrum, but you can have sort of the Chicken Little client who believes the sky is falling, therefore we own gold because, the end of the world is nigh. There is that investor who's interested in gold. There's also the investor who's saying, like we started the conversation today, but if I maximize growth, I've got to have liquid assets that allow me to, as I rebalance from gold into equities or from equities into gold, lower my risk profile even as I'm maximizing growth with equity exposures or privately held businesses or what have you. We see a lot of investors who are entrepreneurs, run a medical clinic, run this or that, and their cash flow is large enough that they just say, of course, I want a part of my assets in enduring wealth. Here's my source of creating riches, and here's how I'm creating enduring wealth. The wealthy have always done this, whether it's buying property or buying art to hang on a wall or filling a safe full of gold. It's a good problem to have. Excess cash flow. Now what do you do with it? Is it just to create more cash flow, or do you ultimately say, I want some diversification, that's why I've got art on my wall. I want some diversification, that's why I bought this ranch. I want some diversification, that's why I own these gold bars or silver bags or what have you. So there is the enduring wealth aspect, which gold is always going to fit. As you described, the value of equities is the cash flow from that business. The future, what you're paying for in an equity position is all of the future cash flows of that business. Okay, so you're not harnessing
Correct.
that with gold and silver. You're not harnessing that with gold and silver, but you can still compound your ounces the way you compound your growth. It's just in a different fashion, using math. It's brilliant.
Would you say that that's a quick question there. Would you say that compounding of ounces, that's driven by the intrinsic value of the metals themselves growing over time, right?
Yeah, it's an
And
intra-market arbitrage, going back between looking and saying which is a better value today. It forces the equation. Instead of having, like, I love gold, I love gold, I love gold. Or some people would say, I love silver. Be agnostic when it comes to metals and recognize that there's periods of time where things are overvalued. For instance, what the heck is palladium doing at $2,600 when 15 years ago it was at $100? Is it really more valuable than platinum? I mean, American Express doesn't have a palladium card. They have a platinum card. Why? Because platinum has always been the cat's meow. It's always been the premium asset. So today you can look at it and say, okay, well, platinum is trading at a discount to palladium. What do you buy in the platinum group metals? The expensive one or the cheap one? Use the value mindset, the value-oriented mindset that you do with equities. I believe you do with equities when it comes to gold and silver and platinum and palladium. And now all of a sudden you're gearing a portfolio to always be in search of value. I'm going to own platinum today until the ratio to palladium improves, and then I'm going to go from one to the other. And I'll be able to increase the number of ounces that I have while not adding more money to that portfolio. Does that make sense?
Quick question there. You're talking about the ratios between different metals. Understand the concept of overvalued versus undervalued applies the same no matter what asset class you're talking about. That makes total sense. What I'm wondering is, how do you know the intrinsic value of a metal if it doesn't produce cash flow? What is that would be my question.
Yeah, well, I mean, and that's a tough question to answer, because the intrinsic value. What's the intrinsic value of Bitcoin? What's the intrinsic value of Ethereum? There's I think a couple ways that you could look at it is, what does it cost to mine this asset? What does it cost to mine this asset? Does that give me any basis of value? And adjusted for inflation, where is the price trading? So you look at the cost of production. You can look at how that asset adjusted for inflation is trading. And am I paying over or under those values? Those give you some reference points, but it's different than the question you're asking. And I think in fairness to your question, I don't know that you can say, many people like to say, well, gold has intrinsic value. Well, how's that derived? I mean, you're asking the engineer's question. It's a great question. And many gold investors pretend that they know what the intrinsic value of gold is. What I can say is that you and I labor in a day, and our labor is worth something. Maybe at the end of the year, it's worth $100,000. Maybe it's worth $1 million. What you're doing when you're saving is you're bottling up the energy, the excess energy from your productivity, and putting it into something. So it's like the difference between potential energy versus kinetic or actual energy, right? Savings represent potential energy. Now you just want your potential energy to be applied when you want it applied to the marketplace, and it needs to hold its value through time. Gold has become the reliable store of potential energy, where your savings, the value of all of your work and effort in a year, is now bottled up and accessible to you. You can turn those ounces into a house. You can turn those ounces into a future business venture. You can retranslate, right? And so I think a part of the value of gold is sort of its reliable purchasing power through time. Again, these are ways that you can rationalize why you own gold and why it has a value to you as an investor. But there's no way of saying the intrinsic value of gold is X. You can't do it. You just have that. You have what you're really leaning on is human behavior, for whatever that's worth. maybe that's terrible. But
no,
this
that's
goes back.
Excellent answer.
The safe haven aspects of gold. This is where again you look and you say, well, it's different this time. Bitcoin's replacing gold, why would you need that old anachronistic asset when we've got the new and the better, and there's mining aspects and there's all this stuff with Bitcoin? Look, when push comes to shove and there's the market's under pressure, interest rates are on the rise, I can tell you what gold's going to do. I can extrapolate off of past behaviors and give you a pretty good idea of how gold is going to behave, because I know how human beings behave. And gold is just an expression of the greed-fear equation. To the degree that people are greedy and want to see growth, gold will be a neglected asset. And I can't have that conversation with you about cryptocurrencies or other potential gold alternatives because there's not enough history. There's not enough history. I mean, you can go back to 2008, okay, but that's a very short history if you're talking about the march of mankind through the ages. Whereas we have a lot more data when it comes to gold and how people behave through various market and business cycles, even war, right? So this is where I can't give you a straight answer, but I can give you a pretty good indication of where things are at and why I think they're priced there. So anyways.
Yeah, no, thank you. I appreciate the detail on the answer. I think that it's a very good one because you can look at long-term data, right? There is some long-term data for gold, for precious metals, similar to equities. You can't say the same things about cryptocurrencies. And,
yeah, so let me give you a ratio. We've been talking a lot about ratios, and maybe not all of your listeners are yeah. But you're an aerospace engineer. You've got to love the math here. If you look at the ratio between the Dow Jones Industrial Average and gold, so again, you're talking about something that's people consider to be growth oriented. If you own the Dow, 30 companies, how'd they get there? Who's there? Why are they there? They made the cut in terms of being a reliable business structure that they think is going to continue to move forward through time. Of course, the constituent parts change, but be that as it may, the Dow Jones compared to gold. We talked about the gold-silver ratio. Here you take the Dow and divide by the price of gold. Numerator, denominator. Okay, so take your 35,000 and divide by 1,847. Gives you 20 to 1 on the ratio. So now you can look and say, okay, I just want to do a behavioral study of investors looking at gold and the value of gold versus equities. So you go through, the early, let's look at 100 years of data here. And you go through, the early stages, the first 20 years of equities in the 20th century. Okay. And there's a huge growth, right? Huge growth. And so not a surprise, gold is just money. As equities go up, your purchasing power in equity terms is huge. You go from low single digits, 3, 5, 7 ounces, have the equivalent value of one cross-section of the Dow. At the market peak, 1929, you're at 18 or 19 to 1 on the ratio. So you could exchange your equity portfolio in the Dow for 18 or 19 ounces of gold. Gold's not worth much. Equities are, everyone loves equities, 1929, right? Well, and then you mean revert and you go from an 18 to 1, 19 to 1 ratio down to a 1 to 1 ratio. We've got the stock market crash in 1930, 31, 32, and you're back to a 1 to 1 relationship. You can exchange your stock portfolio for exactly 1 ounce of gold. And then it marches from that point forward. If you look at the growth in equities through World War II, through some of the great, post-war growth, 1949 to 1968 was one of the great periods of growth in equities. And you go from 1 to 1 all the way up to 28 to 1. 28 to 1 by the time you get to 1968. So now your equity portfolio has far surpassed the growth in gold, right? And where do we go from 1968 to 1982? You go back to about a 1 to 1 ratio, where your equity portfolio only buys you 1 ounce of gold, or said differently, 1 ounce of gold buys you the entire cross-section of the Dow. Now you march towards 2000, the dot-com boom. This is an incredible period of growth. Not only are interest rates coming down, which has a huge factor for growth in terms of equities, but on that basis, everyone's interested in equities. You've got so much growth. Gold becomes a neglected asset. By the time we get to the year 2000, the ratio is about 40-1. Your equity portfolio buys you 40 ounces of gold. By 2008, in the stock market crash, the global financial crisis, we got to about a 6-1 ratio, which is pretty high, actually. It should have been about a 3-1 ratio, but we had massive interventions, the likes of which the world had never seen from the world central bankers. Mario Draghi, 2011, comes onto the scene and says, for the ECB, we will do whatever it takes, and rallies back equities in Europe. And Ben Bernanke does the same here in the United States. My point is, stepping back from the Dow Gold ratio, where you have extremes of greed, 1929, fear, 1932, greed as it slowly builds back to 68, fear as you go through the inflationary 70s, and the stock market finally bottoms in 1982, greed as you rise to the crescendo in the year 2000, and a 40-1 ratio. Today we're sitting at a 20-1 ratio, a 20-1 ratio. So we think in nominal terms, equities have done so well, and yet they're only trading at half of what they were vis-a-vis the year 2000. That in itself is a fascinating discussion. But I think we go back to a 3-1 ratio, a 1-1 ratio, as we see people come out of equities over the next couple of years. I think we've put in a market top. That's my personal opinion. We could have a detailed discussion as to why that's the case. Maybe you should join us for the tactical short call on Thursday. It's our best case of market structures and the frailties in equities today. But I think you have the opportunity to take an equity portfolio and see growth off of a 20-1 ratio down potentially to even a 1-1 ratio. But a more conservative estimate might be a 3 or 4-1 ratio. So you're talking about 5 times growth in purchasing power, utilizing your equity portfolio to buy gold today, and then reverse course. As people are panicked and selling out of stocks at lows, do you want to be the guy who's sitting there with gold ounces, who's putting those ounces to work and multiplying your purchasing power? I want to be the guy in 1932 who on a 1-1 basis is taking 1 ounce of gold and buying equities. I want to be the guy who in 1982 is taking 1 ounce of gold and getting ready to ride the equity bull market of a lifetime back up to 20 or 30 or 40-1. So these relative relationships are very powerful. And gold, yes, while it is a safe haven asset, if you understand time, if you understand the data, if you understand the relationships between asset classes, you can harness exponential growth like you can't imagine. I love the way these big asset class moves work. It just takes time and patience. I mean,
yeah, thank you for that. And so relative valuation, clearly very important. We can look at the data between asset classes and also within asset classes to better understand where we're at compared to market history. A final question for you here, David. We talked a lot about, performance and correlation, lots of great discussion. Can we talk about the other side of the equation real quick of fees? What kinds of fees should the individual investor expect for owning an asset like gold compared to something like an equity index fund where you're talking, 4 or 5 basis points sometimes on an annual basis to own that kind of asset? What are we looking at as far as gold for the individual investor?
Yeah, your transaction costs are higher and your carrying costs are higher. And I say the carrying costs are higher because you're dealing with a real asset that has insurance attached to it. It has hard costs attached to it. So if you want your gold stored in a Lloyd's of London insured bank vault, in our case with Vaulted, it's also a crown property. The Royal Canadian Mint is actually tied to the Queen's name and reputation. So you get a crown property. We're basically paying rent there, plus we've got insurance on the product. Like these are costs that mean it's going to cost you 40 basis points every year to own that asset, and that's more than you're going to pay. Which historically
is very low, right?
Yeah, I mean, you can get your own insurance, if you want. You pay insurance on a house, right? And I don't know if you've ever figured out the basis point cost on that versus the value of the home, but we that's what we do if you want a physical, tangible asset to be protected. So those carrying costs are there. 40 basis points is what it costs. That's the same as GLD. Our vaulted program is no more expensive than GLD in that sense, but with the benefits of, allocation to you, deliverability to you, et cetera, et cetera. The upfront costs are also more expensive. We've compressed the costs as much as we can with vaulted. There is a whole range. If you're talking about what we mentioned before, gold delivered to your door, you could see fees from 1% up to 10%. And who you're dealing with and how much value is added. These are all relevant things to have in the equation. Vaulted is 1.8% above the spot price for gold on a purchase or liquidation. Again, if that seems high, bear in mind that we've taken out all of the middlemen and are buying the gold directly from the Royal Canadian Mint. So our cost does not include a market maker who's sitting on inventory and marking up the product. And so you're talking about 1.8% above the melt value of gold, which in our industry is very cheap. Have to adjust your mindset to a 4 basis point, trade with Vanguard or what have you. Obviously, it's a lot more. But I think that we've done a good job in compressing the costs as much as possible. 2, 3, 4% is pretty typical. And what we've basically done is said, okay, well, it's 1.8%, but boom, we've taken it down to the basis in terms of gold, and its raw mined costs. So a pretty good deal through the Royal Canadian Mint and our vaulted program.
Excellent. Well, thank you for that. It sounds like you all are doing some great work to, I would say, modernize the process of buying and owning gold, and it is a physical asset, which of course has its own unique characteristics and pretty fascinating stuff, especially for someone like me who historically has just studied equities, almost exclusively. It's really a different world, and I can see the benefits there. Of course, there are cons, just like with anything, but I can see how, as a safe haven, hedge against certain events in the markets, it could be beneficial. So, David, before we go, can you tell us a little bit more about Vaulted? Where can people find out about Vaulted? Where can they sign up or get more information related to the product?
Yeah, at the App Store, you can download the Vaulted app. And if you prefer, working on a laptop or whatever, vaulted.com. And it'll walk you through the steps of opening an account and funding the account. It's pretty straightforward there. We work with a third party that verifies, and stands in between for the integrity process of funds coming from you to us and back, a group called Plaid. And so, you open an account, you transfer funds through Plaid onto the Vaulted platform, and then you're ready to purchase the asset. Vaulted.com, that's one place, and the Vaulted app, it's pretty easy to access. We love talking about the financial markets and everything that impacts the financial markets. We probably take a bigger picture, sort of macro view. So this year, starting in March, will be our 15th year of a podcast we've done every week. So I don't know, it's 800. We'll quickly be coming closer to 1,000 episodes, and talking to world central bankers, leading academics, you name it, they'll be on the podcast with us. And a part of what we're trying to do is just get to the truth of the matter. What's going on in the markets and why, and what impacts the markets and why. You look at uncertainty as a factor that impacts sentiment in the market. You're an equity investor. Sentiment has a big play in whether or not things are going up or going down. If there's a bullish trend in play, you can be a company that doesn't earn any money and still your share prices are going up. Or you can be a company that's making a ton of money and your share prices are not going up. Or both are going down. Sentiment and the backdrop has a lot to do with it. What we'll explore in our podcast is often the background as to why sentiment is what it is. I love what you're doing. And I'm grateful that you're looking at individual equities. We take sort of a macro view. sounds like you're doing sort of bottom up work. We would be a top down complement in terms of a macro perspective. I think that's a good resource if people are wanting to learn. So weeklycommentary.com, vaulted.com, or just vaulted at the App Store.
Excellent, David. Thank you. And I will tell the listeners out there, definitely do check out McAlvany Weekly Commentary. I listened to a few episodes, and it is very interesting, especially looking at it from, like you said, David, the macro perspective. It's a different perspective than what I'm used to, than I think what a lot of you out there listening are used to, because you're looking at the big picture. And as investors, we need to be better thinkers, which requires not just zooming in, but zooming out also. And both modes of thinking are especially useful when considering any type of investment. So definitely go and check that out. David, thank you again for joining us here on Stock Stories, and I appreciate your time today. Thank you.
Great to be with you. Thanks for having me. I really enjoyed the conversation.
All right. Awesome. I hope you enjoyed that interview with David McAlvany. I think we had an excellent conversation where we covered a lot of things. We talked about fees, we talked about asset allocation, we talked about concept of intrinsic value. We talked a little bit about macroeconomic trends. I mean, these are all important things to think about as investors, whether or not you are investing in stocks, bonds, gold, real estate, whatever asset class you're investing in. They're all important concepts to understand. Now, I hope that you gleaned a lot from that interview. I'm definitely going to be listening over to that interview multiple times to make sure I got everything in it. So check it out again if that's helpful for you. And also, if you're interested in investing in gold, check out the link in the description for Vaulted as an interesting resource that could help you in your investing journey. So with that, thank you so much, and I'll see you on the next one.